Alright guys, so welcome back to another video. Today we are going to continue our financial education learning session, and the topic for today is a deep dive into investing. So what I've searched here is Investing 101, which is the difference between stocks, bonds, ETFs, and mutual funds, and how compound interest works, and why starting early beats trying to time the market. And as always, we have Grok on the left and ChatGPT on the right. So in the past few videos, we've noticed that Grok provides a more detailed and analytical explanation, while ChatGPT provides more of a basic explanation that's easy to understand. So I think we're going to dive into Grok first, as always, and then we jump back onto ChatGPT. So here we go. Let's dive into Investing 101. This is your crash course on building wealth through the basics: stocks, bonds, ETFs, and mutual funds. How compound interest turns small sums into big gains, and why starting early trumps trying to outsmart the market. I'll break it down with examples, numbers, and no fluff. Let's get to it. The difference between stocks, bonds, ETFs, and mutual funds. These are the building blocks of investing. Each has its own flavor: risk, reward, and purpose. Stocks. What are they? Ownership slices of a company. Buy a share of Apple, you're a tiny co owner. How they work: prices go up and down based on company performance, market vibes, and news. You make money via the price gains. Buy at 100, sell at 150, or dividends. Example, $1 a share annually. Risk versus reward. High risk. Apple could soar 20% or tank 30% in a year. Historically, stocks average 7 to 10% annual returns. For example, the S&P 500, which is adjusted for inflation. Example: $1,000 buys 5 shares of a $200 stock. It hits $250 in a year, and now $1,250 plus $10 in dividends. So, which gives you a total return of 26%. But it could have dropped to $150, which gives you a loss of 25%. Best for growth seekers with time to ride ups and downs. Now we move on to bonds. What are they? Loans you give to companies or governments. They pay you interest and returns the principal later. How they work: buy a $1,000 bond at 3% interest, get $30 a year for say 10 years, then $1,000 gets back. Prices can fluctuate if sold early, but you're safe if held to maturity. Risk versus reward. Bonds are in the lower end of the risk spectrum, as governments rarely default. US Treasuries are gold standard safe. Returns are modest, 2 to 5% historically, and corporate bonds riskier with higher yields, for example 5 to 8%. So, moving on to an example. $1,000 in a 10-year treasury at 3%, you pocket $30 per year, which totals up to $300, plus the $1,000 back. Steady but no big wins. Best for stability, income, balancing stock risks. ETFs, also known as exchange traded funds. What are they? Baskets of assets, stocks, bonds, etc., traded like stocks on exchanges. How they work: an S&P 500 ETF, for example the SPY, holds bits of all 500 companies. Buy one share, for about $500, you're in the whole market. So low fees for 0.03 to 0.5% annually versus a mutual fund. Risk to reward depends on what's inside. Stock ETFs matches stock risk to return, about 7 to 10%. Bond ETFs are lower for 2 to 5%. Diversification cuts company-specific risk. Example: $1,000 in an S&P 500 ETF and the market grows 8%. Now you have $1,080 minus the $3 fee. Crash 20%, down to 800. Still safer than one stock. ETFs are best for easy diversification and for hands-off investors. Now we move on to mutual funds. What are mutual funds? Pooled money managed by pros to buy stocks, bonds, or both. How do they work? You buy into a fund, example a growth fund, with a goal to beat the market. Managers pick the assets. Higher fee. They usually have higher fees of about 0.5 to 2% annually than ETFs. Risk to reward. It varies. Actively managed funds aim to outperform. Some hit 12%, but most don't. Index funds, which mimic the S&P 500, match ETFs at about 7 to 10% with lower fees. Example: $1,000 invested in a mutual fund with a 10% return and a 1% fee. By the end of year 1, you have $1,100 minus the $10, you get about $1,090. For that same fund, in a bad year with a minus 5% drop, the share goes down to $940 after fees. Mutual funds are best for those wanting pros to steer and are willing to pay for it. Quick comparison. Stocks, high risk, high reward, but single bets. Bonds, low risk, low reward, but steady flow of cash. ETFs, medium risk, broad exposure, but cheap. Mutual funds, medium to high risk, managed, and on the pricier side. So Grok here has suggested to mix it in terms of investments with having 60% stock ETFs, 40% bonds, with growth with a safety net. Now we move on to point number 2, how compound interest works. This is the magic sauce of investing. Money making money. Then that money making more money. It's exponential and not linear. The basics. The formula here is A equals P multiplied by 1 plus R divided by N to the power NT, where A equals the final amount, P is the principal, R is the rate, N is the times compounded in years, and T is the years. Simple version. Interest earns interest. $1,000 at 7% doesn't just grow $70 a year. It snowballs. Example: having $1,000 invested at 7% interest rate for 10 years. Year 1, $1,000 into 1.07 equals $1,070. Year 2, $1,000 into 1.07. $1,070 into 1.07, you get $1,144.9. By the time it's year 10, you have, applying that formula, $1,967.15. The key: you put in $1,000 and you earn $967 without lifting a finger. This is called compounding. Double it. Add $1,000 yearly at 7%. Year 1, $1,000 becomes $1,070, similar to the one before. But in the second year, you add another $1,000 on top of the 1,070 you get from end of year one, and you end up with $2,214.9. By year 10, you have $15,600. Your contributions $10,000 with interest $5,600. Lessons: small regular inputs plus time equals massive growth. Real power: $5,000 at 7%. 30 years you have $38,061. Same $5,000 in 40 years you have $74,872. Time doubles your money again. It's not the rate, but it's the years. Why starting early beats time in the market? Investing isn't about guessing picks and valleys. It's about staying in the game long enough to win. Starting early. Example: Alex, who has $5,000 a year, age of 25 to 35, with a 7% return, stops contributing. Let it grow to 65. Total invested $50,000. At 65, he has $602,000. Bella, who invests $5,000 a year at age 35, from age 35 to 65, which is about 30 years, 7% return, total invested $150,000. But by the end of 65, they have only $510,000. What is the takeaway? Alex invests 1/3 as much, ends up with more. Why? 10 extra years of compounding, 25 to 35 versus 35 to 65. Rule: every decade you delay halves your outcomes or triples your effort. Time in the market. What it means: waiting for perfect dips to buy, peaks to sell sounds smart, but rarely works. Data: missing the S&P 500's 10 best days over 20 years, 2003 to 2023, drops your return from 7.6% to 3.5%. Best days often follow crashes. Impossible to predict. Example: time it: $10,000, wait for a dip, miss 8% growth year 1, year 2, invest, grow 7%, ends up with $11,448. Stay in: $10,000, 8% per year, 8% for year 1, 7% year 2, ends with $12,446. Cost: $1,000 loss chasing perfection. Why early wins? Consistency. Dollar cost averaging. Invest $500 a month regardless. Smooth volatility. Buy high, buy low, average wins. Math. Compounding needs time, not timing. A 7% return doubles money every 10 years. Rule of 72. 72 divided by 7 equals 10. Behavior. Time breeds stress, delays, and FOMO. Starting now builds habits. Real scenario. Age 20, $200 a month at 7%. By 45 years, you have $606,000. Age 30, same $200 a month. After 35 years, you have $286,000. Wait 10 years, you lose half your future. Start today, even $50 a month, and you're ahead. Putting it together. Portfolio: $1,000 split, $500 stock ETF, 7 to 10%, $300 bond, 3 to 5%, $200 mutual fund, 8%. Year 1, $70 to $100 growth. Compound: add $100 a month, 7%, with 7% return, 20 years, you have $52,000, and your invested amount is $25,000, and your earned amount is $27,000. Start: $500 a month now at 7% beats $1,000 in 5 years. At 25 years, $500 becomes $2,700 versus $1,000 becomes $3,800. Still less per dollar. Your move. Pick one. Start with an ETF. $100 in VTI or a stock, fractional share of Tesla. I can guide step. Calculate. Got an amount and age. I'll run your compound numbers. Ask, where do you want to zoom in? Stocks, bonds, or timing traps? What's your next steps look like? Okay, so as always, Grok has a bit of a more analytical breakdown of investing 101. So I'm just very curious to see what ChatGPT comes up with because we have a bit of a longer explanation this time, I think. So let's dive right into ChatGPT now. Investing 101. A deep dive into stocks, bonds, ETFs, and more. Investing is a powerful tool for growing wealth, but navigating the options can be overwhelming. Let's break it down step by step. Covering different investment vehicles, the magic of compound interest, and why time in the market beats time in the market. Understanding investment vehicles. There are many ways to invest, but the four most common types of investments are stocks, also known as equities. When you buy a stock, you own a small piece or a share of a company. Stocks offer high growth potential but comes with higher risk. Prices fluctuate based on company performance, economic factors, and market sentiment. Example: investing in Apple means you own a part of Apple Inc. Bonds, fixed income investments. Bonds are essentially loans you give to a company or government in exchange for interest payments. They are generally safer than stocks but offer lower returns. Prices depends on interest rates. When rates rise, bond prices fall. For example, US Treasury bonds or corporate bonds. Exchange traded funds, ETFs. ETFs are baskets of stocks, bonds, or other assets that trade on an exchange like a stock. They offer diversification at a low cost. For example, S&P 500 ETFs, SPY, and VOO track performance of top 500 US companies. Mutual funds. Mutual funds pool money from multiple investors to buy a diversified portfolio of assets. They are actively or passively managed and often have higher fees than ETFs. For example, Vanguard 500 Index Fund tracks the S&P 500 but is managed as a mutual fund. The power of compound interest. Compound interest is often called the eighth wonder of the world. It allows your money to grow exponentially over time. Formula for compound interest. A is your future value, P is the principal or the initial investment, R is the annual interest rate, and N is the number of times interest compounds per year, and T is the number of years. The formula that we use is A equals P times 1 plus R divided by N to the power NT. Example: investing $1,000 at an 8% annual return compounded annually, after 10 years you have $2,159, after 30 years you have $10,062, after 50 years you have $46,901. The key takeaway: the earlier you invest, the more time your money has to compound. Time in the market versus time in the market. Many investors try to predict when to buy low and sell high, but this is nearly impossible to do consistently. Instead, stay invested long term is the best strategy. Why starting early is better than market timing. Missing just the 10 best days in the market over 20 years can significantly lower returns. Invest during a market peak, but staying in the market for decades often beats waiting for the perfect entry. Example: Investor A starts at the age of 25 and invests $200 a month until 65 and has a total of 96,000. Investor B starts at the age of 35 and invests $300 a month until 65 and has a total of 108,000. Investor A ends up with far more because their money had more time to compound. Key takeaways: stocks offer growth but are riskier. Bonds are stable but lower return. ETFs and mutual funds provide diversification and ease of investing. Compound interest rewards early investors. Start as soon as possible. Time in the market is better than trying to time it. Investing isn't about quick wins, it's about long term growth and discipline. The best time to start was yesterday. The second best time is today. So, that was, I think, a good breakdown. And let me know what you guys are investing in after reading this, or if you guys are even investing in anything. Um, I think right now is actually a perfect time to have this bit of information because the market is in a bit of a range or slash a downturn. But I think there is one more leg up in this bull market that we are in right now as of 29th of March. I know that due to economical conditions, as we discussed in the 2008 crash 2.0 video, there is a bit of a short-term breakdown of market structure, and I think these prices are perfect for anyone who wants to buy and get into the market. So I hope this video helps you to better understand what and why we should invest early, and the earlier the better. And yeah, if you want to learn more about finance, please like and subscribe. And I will be uploading new videos every day. And let me know if there's anything specific you guys want me to cover. And yeah, that's it for now. Cheers.